When it comes to markets, appearances can be deceiving. Last night in the US, we saw a flat result for the Dow Jones Industrial Average. The S&P 500 came under a little pressure, and the Nasdaq was hardest hit, down just 0.2%. And at that index level, it doesn't look like too much was going on. But if you fell for that one, you missed the ability to drill down into the market action. And it's very important on a trading night like last night to do exactly that, because what we saw was very instructive about the near-term outlook for the share market. Now, let's remember that we've got the macro issue of the meeting of global central bankers in Wyoming, and a very important speech is expected on Friday night, our time, from the chair of the Federal Reserve. Now, the reason the markets are so focused on this are political and economic. In the past, the Fed has used this platform to announce policy changes. And in fact, it was only 2 weeks after a meeting that the Fed embarked on a significant rate cutting program. And so markets are looking for a potential change in policy, but also potentially a response to the political pressure that's being applied to the Fed. Now, the chair, Mr. Powell, is due to step down in May next year. He doesn't have anything to lose by speaking his mind, and this might be the opportunity to take. So whatever happens with this speech, a damp squib seems unlikely. Market volatility could increase significantly on Friday night in the US and into next week across the Asia-Pacific region. It's a macro event we can't ignore. But while that's certainly hanging over the markets, we've also got the micro drivers. And the reporting season here in Australia and in the US is driving enormous moves in individual stocks. It's a good time for all investors to be paying attention when stocks are making moves of more than 20% on the back of their earnings announcements. It can make a significant difference to any portfolio, and means that paying attention right now could be very important for your future wealth. So we did see the Nasdaq dragged down by the big tech stocks, just as we'd seen the previous night. Those formerly very popular market darlings, the big tech stocks, the mega caps, were the ones that led the market lower at the previous session and in last night's session. We saw Apple down 2%, Amazon down 1.8%, Tesla down 1.6%, all of those leading names coming under pressure. And it did look like there was some profit taking around that. Nvidia's day was fascinating. It was also hit hard along with the other tech mega caps. And yet over the course of the trading session, it bounced back. And in fact, only closed down slightly after a very torrid session. And that probably reflects the fact that its result is due very soon. And there are many commentary pieces around the idea that Nvidia will report even better than the very frothy market expectations and possibly drive the stock to all-time highs. Now, that's a very optimistic view in my opinion, but it's certainly one that's got legs in the market at the moment. So we're now looking at a positive lead-in for the Australian market. Yesterday, the ASX was up 0.25%, but the leading stocks were actually under pressure. And if it weren't for a very strong performance from the major banks, the Australian share market could have been significantly lower in trading yesterday. So it's something we're watching out for today. But it's very clear that after the Reserve Bank of New Zealand cut interest rates yesterday, that some investors at least drew a straight line to Australia. Now, once again, in my view, this is a mistake. One of the things we've learned about central banks over the course of this year is that they're very much focused internally on their own economies. And so it's the data within their own economies that's likely to drive the actions of central banks all around the globe, including here in Australia. So the RBNZ responded to the New Zealand economy with its rate cut yesterday, and investors, in my view, mistakenly drew a straight line to the RBA, because the best performing sectors yesterday were all of those interest rate sensitive sectors, the banks, the insurance companies, the property trusts, and property trusts were quite a feature. HMC was up 18%, Centura was up 11% on very little news other than that news out of New Zealand. So the strength that we saw there could be reversed today if people start to move away from the idea that just because the RBNZ cut rates, the RBA will too. But once again, results are really driving movement. Yancoal down 11.5% after announcing a 60% drop in profitability for the half. Very concerning developments there, and some concerns about prices realised, and a swift re-rating of the share price in trading yesterday. But the worst performer and the hardest hit was James Hardie. Now, James Hardie is already at loggerheads with its shareholders, having announced a few weeks ago a deal whereby it will take over a US group called ASEC, Building Materials Group, and in doing so will move its primary listing from Australia to the US. And it made this very significant change to its capital formation without consulting with shareholders. So institutional shareholders very concerned about management at James Hardie. For them to then unveil yesterday a shocking result. And while it was expected there might be some softness, the weakness in their revenues in particular and the decline in their profitability saw the market absolutely trash James Hardie's share price. It was down 28% in trading yesterday. And given that very poor outlook, a management team that are on the nose with institutional investors and a declining outlook for revenue, we could see further pressure on the James Hardie share price. Looking at US trading last night, we did see a big hit for Target. It fell down 6.3% in trading last night on the back of declining sales. And that's despite a fairly good profit report for the quarter. It was the outlook that really drove it down. However, the focus in the US for retail will be Walmart. They are reporting tonight. They're about 10 times the size of Target. And so that will inform not just Walmart shareholders, but give investors generally a good idea of how the US consumer is travelling. So far, we've had about 92% of the S&P 500 companies report, and it's a very positive quarterly season. Overall revenues were up around 6% across those 470 companies, and profitability was up around 11%. Now, the standout performers were no surprise. We saw a very good performance from tech stocks in terms of profitability increase. We saw good performances from financial stocks. Perhaps the surprising one and the best performing by sectoral analysis was the communications group, where we saw profitability up 44%. So some very good reports, and overall, what we saw this reporting season was positive for the US outlook, the increase. And not only did we see that increase in profitability and in revenues, but both of those numbers beat expectations. And that's another reason to think that the rallies that we're seeing in the US could be sustainable, despite our concerns about stretched valuations. The earnings season continues in Australia today. We've got possibly the biggest day of the reporting season. I counted more than 56 companies reporting today, and they include Goodman, Brambles, Northern Star, the gold miner, Domain, Whitehaven Coal, Megaport, and the dual-listed Auckland International Airports and Sky City. So there's plenty for investors to focus on today. There's real potential for market movements given the savage and sometimes buoyant reactions we're seeing to company reports. It's a good time to be alert.